Hey everyone and welcome back to another video. My name is Hamish Hodder and today we're going to be having another look at stamps.com. So if you're a long-time viewer, you might remember that a while ago, about a year ago, I made a video on stamps.com, sort of analyzing it and breaking down its numbers, as well as its economic moat, its management, and also doing a valuation on it. Now, since that video has come out, the stock has fallen from an all-time high of 70%. So it's dropped 70%. And that actually includes a 1 day drop of 58%, which is crazy to see a stock fall that much in a single day. So of course, a bunch of you guys were commenting on that video and asking me to give an update on my thoughts on the stock, because at the time, one of the buy prices that I included in that video was about $120 per share. It's now at under $100 per share. So a bunch of you are asking, is this now a buy? Is this a buying opportunity? So I have to cover that, and I'm going to talk about some of the points that I made in that video and sort of share with you how my thoughts have changed, if they've changed at all, which they haven't really changed at all. But I'm going to talk about how my opinion has sort of shifted over the past year. And I'll also give you an update in terms of what I think about the stock as being a buy at the current time. So if you do enjoy the video, make sure you leave a like and let me know your thoughts on stamps down in the comment section below. If you're an investor in stamps or if you've been researching it thoroughly, then I'd love to hear your thoughts on the company down there. But for now, guys, let's jump into it. All right, so let's start by talking about that previous video. So I spent a significant proportion of that previous video, that analysis video, talking about the economic moat that stamps may or may not have. Because essentially, if you know the method that I use, I go through a qualitative analysis and a quantitative analysis. And in terms of the quantitative analysis, stamps ticked every box you could possibly think of. Their growth numbers have been crazy, or they were in the past, at least over the past 10 years. They were exceptional, and that would indicate that there is some kind of economic moat there. However, we also need to do a qualitative analysis. We need to look at what those numbers tell us about the business and what is the context of those numbers. Because just looking at those numbers in isolation, it looks that Stamps has had a really strong economic moat and that they will continue to have one in the future. However, those numbers, as I said in that video, those numbers were tied to the fact that Stamps had an exclusive partnership with USPS. So the economic moat that Stamps had in the past was the fact that they had that exclusive partnership that allowed them to reduce a lot of their costs. However, at the time of making that video, USPS was in negotiations with Stamps in order to make a new contract, because it became the time that the contract was expiring and they needed to renegotiate and build another partnership. And essentially what I said in that video was that if their continuance of great performance, so their performance in the past, if that's going to continue in the future or anywhere near as it has in the past going into the future, then they need to get another exclusive partnership that is going to be locked in for the long term. And the reason for that was because the stock was priced to grow as it had in the past. The market was expecting that growth in the past of, I think it was like 30% EPS growth per year for 10 years or something ridiculous. They were expecting that growth to continue in the future. And the only way that happens is if they continued with this partnership. And I essentially said that I didn't want to touch this stock until I knew that they had an economic moat, because up until that point, they might have had an economic moat. I think it's pretty obvious that they did, considering their performance. But from that point where they negotiate the deal, whether or not they have an economic moat going forward really depends on whether or not they can seal another deal with USPS. So fast forward to the 21st of February 2019, and Stamps announced that they would not be making an exclusive partnership with USPS. And it is on that day that their stock went down 58% in a single day, which is one of the most dramatic drops in a stock price that I have ever seen. It was quite spectacular. The CEO of Stamps essentially said that now that Amazon has this 2-day shipping, their customers are requiring, or they're demanding, that Stamps offer 2-day shipping. And this is something that's just not possible with USPS. It's possible with FedEx and UPS, and DHL is the other one, that's right. It's possible with those carriers, which is why they wanted a non-exclusive deal with USPS. They still wanted to deal with USPS, but they wanted it to be non-exclusive so that they could also partner with these other carriers, these private carriers, that would then allow them to offer 2-day shipping. And USPS essentially said that we're not going to make a non-exclusive partnership with you. We only want a partnership with you if it can be exclusive. And the result of that partnership falling through is that Stamps revenues for this year are going to fall 8%, which is very different from what analysts were expecting, which was an increase of 16%. So that brings us to talking about the valuation. What did I say in that previous video a year ago would be an appropriate buy price? And do I still stand by that? What do I think about the valuation now? So back when I made that video, I essentially used Phil Town's margin of safety method, and I used a growth rate of 12% per year for the next 5 years. And that gave us a fair value of $254 per share, which would mean that it would be a buy at about $127 per share. Stamp's current stock price is about $100 per share, so that raises the question, is it now a buy? Because it's below that buy price that I put into the calculator 1 year ago. And the short answer is no, and the reason for that is because in the past, their past performance was dependent on that deal with USPS. And me assuming that 12% growth rate in that calculator was assuming that that partnership would continue. And now that that partnership is not going to continue, we have no idea what their performance is going to be like. We can't use their past performance as an indication of future performance because the situation for the company is now completely different. And for that reason, I would not be confident in using a 12% growth rate going forward. And look, Stamps might perform really well in the future. They might go on to make 10x over the next 10 years or the next 5 years. I have no idea. They also might perform really horribly and they might destroy shareholder value. Again, I don't know. And the reason that their performance could be somewhere between these two massive swings is because they now lack an economic moat. They might have had one in the past and they had one up until the point where they needed to renegotiate. But now that they don't have a deal that reduces their costs and that gives them an intrinsic, unique characteristic over other companies, there's nothing to say what their growth is going to be. There's nothing that we can look in the past of their past performance that could be a good indicator of what they're going to do in the future. So what's the major lesson that we can learn from this situation that you've been observing over the past year? And I think there's 2 lessons, but there's one major one. And it's to only invest in companies that have strong, wide, and compelling economic moats. And how we identify that is that these companies need to have some kind of unique characteristic that is intrinsic to the company that is protecting it from other businesses in the industry. And Stamps had this when they had their deal with USPS, and they had it up until the point where it was renegotiated, but that is now gone. And a smart investor in this company might have been invested in Stamps up until sometime last year, and then started to offload their shares because they recognize that while this deal is being renegotiated and until it is confirmed that they can continue to have this exclusive partnership, the economic moat of this company is deteriorating and going away. And a smart investor would have used that opportunity to get out of the stock while it was really high and while it had returned a lot of profit to the shareholder over the past few years. And the second lesson is that you must understand the business completely. Someone who just came across this stock, typed in the numbers and looked at the numbers might have gone, yep, they've grown at 35% per year in the past. They can do that for the next 10 years. And putting that in, I think I did this as an example in that video, it would have given us a buy price of $250 per share, which was the current stock price. So they could have invested at that price blindly and then lost 60% of the stock. And not only would they have lost 60% of the stock, the value of the company has come down dramatically, which is what's unique about this circumstance. It's not a company that has a massive drop in the stock price, but nothing has affected the operations of the business over the long term. This is a company where the stock price has come down because the long-term value of the company has also come down. So the ultimate question here that people are asking is, should I invest in this company? And it really comes down to a few things. The first thing is that you need to make sure you completely understand this business. You need to understand what this no deal with USPS means going forward. What are their costs going to be, their increased costs over the next 10 years? How much revenue are they going to produce over the next 10 years? And how is that going to be affected by the lack of this deal? And from that, you can start to calculate a ballpark of how much cash you can expect to get back from this business over the next 10 years. And if you completely understand the business, you think that it has a wide economic moat, and you can fairly accurately estimate how much cash you can get back from this company over the next 10 years, and the stock price is significantly lower than how much cash you can get back, then under those circumstances, this might be a good investment for you. An important thing to mention here is that you cannot buy the stock with the assumption that they're going to make a deal. If you're just buying the stock in the hope that they make a deal with USPS or someone else, you are completely speculating, because unless you have overwhelming rational evidence to suggest that they're going to make a deal, which if there is, it's likely the stock price will have already moved in that direction or already, then unless you have that, you're just betting, you're just gambling. You're not making rational decisions by looking at how much cash you can get back from the company. For me personally, this is a company that I really don't find that interesting at all. And for that reason, I won't be making an investment, because I just couldn't sit through hours and hours of research into this company, because it would just bore the hell out of me. So it's a company that I'm not interested in, I'm not passionate about, and for that reason, I won't be touching it. But that might be a company that you're interested in. And if you are, the most important thing is to research. Do as much research as you can and get to an accurate calculation of how much money you can get back from this investment. So that's all I've got for this video, guys. If you enjoyed it, make sure you leave a like. And if you do fully understand this company because you're an investor or you've been researching it thoroughly, then I'd love to hear your thoughts on this non-deal down in the comment section below, and I'd love to have a discussion with you. So make sure you leave me a message down there. But for now, guys, I'll see you in the next one.